In this video, we will learn how to calculate a shareholder's dividend income. A dividend is any distribution of property made by a corporation to its shareholders out of its earnings and profits account. It's also known as E&P account, earnings and profits. Corporations keep two separate E&P accounts, one for the current year called current earnings and profits, and one for undistributed earnings and profits accumulated in all prior years. This is called accumulated earnings and profits. Distributions are designed or designated as dividends up to the balance of current E&P. Further distributions in excess of current E&P are designated as dividends up to the balance in accumulated E&P. Current E&P not distributed to shareholders is added to accumulated E&P at the beginning of the next taxable year. Okay, so we've got Palmer Company, and they report current E&P of $350,000 and accumulated E&P of negative $250,000. Palmer distributed $450,000 to its sole shareholder, Veronica Jones, on the last day of the year. Her tax basis in Palmer stock is $80,000. And we're required to calculate Veronica's dividend income and tax basis. We're also required to calculate Palmer Company's balance in accumulated E&P on the first day of the following year. Distributions deemed paid out of current E&P are taxable as dividends. Now, because Palmer Company reported $350,000 as current E&P, only that $350,000 is treated as dividends to Veronica. No additional amount is treated as a dividend because Palmer has negative accumulated E&P. In case of positive current E&P and negative accumulated E&P, the distributions in excess of the current E&P would be first treated as non-taxable reductions in the shareholders' tax basis in their stock. And any excess received over their stock basis would be treated as a capital gain from the sale of the stock. Now, Veronica's tax basis in the Palmer stock is reduced by the lesser of the distribution in excess of current E&P or her basis in the Palmer stock. So the distribution in excess of current E&P is $100,000, and we calculate this by taking the difference between $450,000 and $350,000. So Veronica's tax basis in the Palmer stock is $80,000. Now that's given. And because the $80,000 is less than $100,000, Veronica's tax basis is reduced by the $80,000. Therefore, her revised tax basis after the distribution is zero, calculated as the difference between $80,000 and $80,000. So we've got a remaining $20,000, and that is the difference between the $100,000 and the $80,000. It gets treated as capital gain from the sale of the Palmer stock. Palmer's current year E&P is reduced to zero after distributing the dividends to Veronica. The company had a deficit in accumulated E&P of negative $250,000. Therefore, Palmer has a negative balance of $250,000 in accumulated E&P on the first day of the next year.